It looks like the Federal Reserve is not the only central bank around the world experiencing issues with losses this year. In fact, the Swiss central bank just posted its biggest loss in its entire 116-year history. And given the way that things look like they're going to be going for the year of 2023, it doesn't look like this will be a year that central banks will make up their losses. In fact, it looks like their losses, central banks all around the world are going to have losses that will get much worse this year. So what is a central bank? A central bank is a bank for other banks. And so a bank to you is where you put your money, then the bank goes out and does stuff with that money. And then when you want, you go back to the bank and say, hey, give me back my money. And they give you somebody else's money, equal amount that you deposited. Because remember, they're already doing something with your money, like they made a loan with it or they invested it. Now you might think, hey, this sounds like a problem, which is exactly right. And that's why they made central banks, because if too many of you go to your bank and say, give me my money, well, they don't have it. And so they need their own bank so they can go to their own bank, the central bank, and say, hey, give me some money. So the central bank was started for that exact purpose, so that it could be a bank to other banks. So in the event of a local bank run, the central bank could bail out that bank with the use of the funds from other banks. Now, this might seem like a great idea until you realize that you cannot eliminate risk. You can only transfer it. When you buy fire insurance, you're not eliminating the risk of fire in your home. You're just transferring the risk of that fire to the insurance company so you don't have to bear that risk yourself. Similarly, when you have a central bank, you don't eliminate the risk of a local bank run. All you do is transfer all of the cumulative risk from all the bank runs to the central bank. But the central bank can only draw on the funds of all the banks. And so you essentially just transfer that risk to the entire system. And now the entire system is at risk of collapse. Now you might be thinking, well, how in the world could a central bank be at risk for collapse when they can just print all the money in the world? And that's exactly right. Starting in 1971, when Nixon closed the gold window, the central bank, the Federal Reserve, didn't need to hold on to a certain amount of gold anymore for the amount of dollars that it printed. So now, if the system needs more dollars, if a bank run happens and it needs more dollars, they can just print up as many dollars as they need. So when we fast forward to a major financial crisis like 2008, like 2020, well, all they do is they print up a bunch of dollars and buy whatever toxic assets are necessary to keep their prices inflated and bring those onto their own balance sheet. Specifically with the Federal Reserve, you get assets like mortgage-backed securities and United States Treasuries, and they build up a nice portfolio of about $9 trillion worth of assets that are paying them a nice little sum of interest every single month. With the Swiss central bank, they hold other assets as well, other than just currencies and other than just government debt. They also buy stocks like Tesla and Apple and Amazon. Not to mention the fact that they're actually publicly traded, so if you want, you can go buy shares of the central bank in Switzerland. Well, something has happened recently that has caused the nice little monthly dividend checks that these central banks are getting from their trillions of dollars in assets to not be more than their expenses. And that little thing is called central banks jacking up interest rates. You see, central banks all around the world, just like the Federal Reserve, are trying to fight the inflation that they caused by printing a bunch of money. But that means that those central banks have to pay out a higher amount of interest to all the reserves that their banks are keeping with them. This means that many central banks, including the Swiss National Bank and the Federal Reserve, are paying out a lot more than they're receiving in income. Which again, for central banks, not really a huge problem because now they can just print that money. But with the Swiss National Bank, they expect a $143 billion loss for last year. This means that they're not going to make their usual payout to the Swiss government. This is by far the worst loss that they've ever had in their history. Now, that one line may have caught you there, that they're not going to be making their usual payouts to the Swiss government. So what is that all about? Central banks are around the world on some scale between public and private. There are no central banks that are fully private anymore, and some central banks are fully public, meaning owned and controlled completely by the government. But most of them are a mix. So when the Federal Reserve pays out all of its expenses for salaries, interest on reserves held with them. With the Fed, we've got the reverse repo to think about as well. Anything that's left over from their income, they send to the United States government. So the United States government gets a little kickback. They get to spend that money, or makes it softer on their budget so the government has to borrow less or tax less. It's not a ton, but it can help. Well, as a result of increased expenses and losses on their balance sheet, the Swiss government will not be receiving its normal payment from the Swiss National Bank. They had losses on their stock portfolio, their bond portfolio, and they're paying out more interest due to the fact that they raised interest rates to 1% to counter their inflation of 3%. Meanwhile, across the pond here in the United States, interest rates are close to 5%, fighting inflation of over 7%. And that's still less than the Eurozone's inflation rate, which is still over 10. And that's if you accept the official inflation numbers around the world. Now, because of all of this, you've probably seen charts like this one that show the remittances that the Fed owes to the Treasury plummeting off the cliff. This chart back here shows how much money the Federal Reserve was paying to the Treasury on a weekly basis, and now it looks like many people think this means that the Treasury is now sending money back to the Fed to fund those losses. And that looks like a steep drop-off. This is a misconception. The Treasury is not actively sending money to the Fed. The Fed is just building up a big IOU to themselves. They're printing the money in either case. So yes, they're paying more than they're receiving in income, so they have a loss. They just print up the difference. So whatever the banks need credited to them for the interest rates where they're at, that's what they get paid. The Fed just creates that money out of thin air. All this means is that it'll take a lot longer for the Fed to pay themselves back before they start sending money to the Treasury again. And by the way, when I say pay themselves back, it's not like they're suffering or doing without. They print all the money they need anyway. And so paying themselves back is meaningless. It's just something that happens on paper. They pay all the expenses that they have to pay no matter what, with interest rates what they are, with their salaries what they are. None of that changes ever. They don't have bigger bonuses or smaller bonuses like Wall Street does. It's just something that happens on paper, or I should say digitally in a database. Now, even this chart that shows remittances dropping off of a cliff and this big IOU building up is a little bit deceptive. You see, if we zoom in right around here, the Fed changed the way the data was calculated on this same chart. Before this moment, it was calculated as a weekly number. After this moment, it was calculated as a cumulative number. If we look at this release from the Federal Reserve and we scroll all the way down, we can zoom in here. We can see that positive amounts represent the weekly remittances due to the Treasury, while negative amounts represent the cumulative deferred asset position. What this means is that if the Fed has money left over and they're paying money to the Treasury, they add that up every week. They just show what that amount is. If, however, the Fed is paying more than their income is, which means that they're not sending anything to the Treasury, they count all that up, and every single week they just build up a larger and larger number so that they know what the total IOU is that they have to pay themselves back for before they start sending money to the Treasury again. So when we look at this chart, these are weekly numbers, and this is just the total number on any given date. So the real chart would look like this if you were looking at adding up all the money that the Fed had sent to the Treasury on any given date, the cumulative number, and now adding in the negative number. So as of the end of 2022, we are still up here. So this is a much smaller drop when you're actually comparing cumulative to cumulative rather than cumulative to weekly. So what's the bottom line? Central banks all around the world are trying to fight the inflation that they caused by printing a bunch of money. This means that central banks are currently experiencing large record amounts of losses on their assets, which means that central banks are having to print money to make up for their own losses. You can see how this is turning into a snake eating itself by the tail situation. However, it's not actually as bad and doom and gloom as it sounds, because at the end of the day, the money that they're printing to cover their own losses is not enough to make up for the deflationary forces of them raising rates and of trying to fight inflation. And by the way, the amount that the Fed is paying to banks to incentivize them to keep their money with the Fed instead of lending it out and participating in economic activity. That is by design. They're trying to entice the banks to not engage in economic activity. They're trying to slow economic activity down, make lending harder, make money more expensive to slow down economic activity, to slow down growth, to stop inflation. At the end of the day, that's the only tool that they have, is to try and cause people to spend less, which you only can do that by giving them less income. So pay off that adjustable rate debt that you have as soon as possible, or it could get very painful very soon. Because when you have losses that you can't cover, you don't have the legal monopoly on printing money to make up for your own losses to keep on paying yourself exactly what you may need. I'll be speaking in just a few weeks at Jason Hartman's Empowered Investor Live Conference. It'll be in Scottsdale, Arizona. I would love to see you there. Link is in the description below. As always, thanks so much for watching. Have a great day.